Good morning, friends. I'm 𝗰𝗰𝐶𝐻 𝗂𝐵𝐴 from the corporate communication team of HDFC Bank. It gives me great pleasure to welcome all of you on behalf of HDFC Bank for HDFC Bank Day 2023. Today we have with us our senior leadership of the bank here today, and they will of course outline their vision and strategy for the bank for FY24 and beyond. In the very first session, you will get an overview of the bank's strategy from our MD and CEO, Mr. Shareanalysistelugu Jagdishan, our DMD, Mr. 𝐘𝐸𝐻, our ED, Mr. 𝐒𝐻𝐳 Zaveri, and Mr. Srinivasan Vaidyanathan, our CFO. So friends, now without much ado, I now request the four distinguished men on stage, the MD and CEO, the DMD, the ED, and the CFO to start proceedings. Thank you, sir.
Good morning and welcome to all of you. It's always a privilege to meet you all after a long time, after I think meeting you all in a group like this after 1 year. You know, I've been in this meeting you all, meeting a lot of others in other areas of the world, but I think you guys are the most vibrant, I can tell you that. So kudos to all of you. It's now just another 4 or 5 weeks away before the big day is going to be happening, which is the merger with HDFC Limited. I think the team has been working hard in preparation for that. I must first thank the regulators, the government bodies, our legal teams, and the lawyers who have helped in executing this until now on time, or really on nearly on time as expected. It's been a commendable job by all of them, and I'm grateful to all of them who have put in their hard work into that. We've also established a kind of an executive integration committee meeting chaired by 𝐘𝐸𝐻 and from the bank side, and Mrs. 𝗃𝗏𝗏 from the other side. And I must say that with the Apex committee and many sub-operating committees, I think we have come a long way in terms of ensuring a very seamless integration. Though, of course, the real work starts when we announce the date of the merger. But a lot of background work has happened, and we are quite excited about the progress, and we are all eagerly waiting for that D-Day when we can really unleash the purpose of the merger. Before we come to the bank as such, I think you're probably more aware of the macro and what's happening in the system than I do, so I will just skirt it as quickly as possible. We still believe that with all the ups and downs from an external factor, but the global economy that's going through a little bit of a stress, the kind of volatility in input and commodity prices, largely on account of fuel, still India has demonstrated, not just in the last year, but also through the COVID, we have been a very resilient economy. We continue to be the fastest growing, and we will be one of the fastest growing over the next 4 decades, is what a lot of experts have predicted. And I very strongly believe from the kind of energy that we see at the ground level. I think the system continues to be underserved and underpenetrated, and that's what is the joy all about in terms of the opportunity for financial services. I think post-COVID, most of the banking system or the banks have cleaned up their act, and they're all waiting to grow, and they have been growing very well. So the competition is extremely intense, and that's the opportunity for us. I mean, we try and ensure that we don't buckle under pressure. We continue to remain very solid in terms of balancing between quantity and quality. As you know, that's been our philosophy right through over the last 28 years, and that has kept us in good stead. That will not change, and that we have demonstrated in parts in the last 1 year as well. whether it is corporate banking, you will have Azad and Nirav talk about what's at the ground level, but I do see, despite all the issues in terms of high input prices, volatile profitability in corporate India, in terms of some sagging demand on working capital side or a deferment of private capex, still the team finds opportunities to try and have a balanced growth. While you may see on the top line and a very optical muted growth from the corporate side, in reality, actually, it's grown pretty well. They managed, or they have an art of balancing liquidity by selling off a fair amount of them through the short-term liquidity measures called the IBPCs, and sometimes even give up some of the assets, etc. But the core profitability continues to be extremely good from a wholesale banking perspective. MSME, yes, we have been growing very well, upwards of 25% over the last couple of years. That's an opportunity. Though the sector is not necessarily healthy in terms of asset quality, but if you look at our asset quality, because we are positioned only in the top end of every sector in MSME, our book is extremely sanguine. As we expand our distribution, that's also an opportunity for us to garner the top end of each and every of the MSMEs in these geographies. This will continue to chug along reasonably well for over the next couple of years. Agri, a lot of rural, a lot of people have discussed about the kind of commentaries that one has heard from the FMCG companies that rural demand is weakening, but financial services is slightly different. Yes, from an FMCG perspective, when you look at the sachets and all these kind of products, which is already saturated, we are still underpenetrated. And we try and do the middle and the upper middle income in the rural segment and not go down the risk ladder. That has been the customer segmentation focus, and that continues to be the case. When we go down for a priority sector perspective, especially a small and marginal farmer, we do it on a very secure way, which is the reason why we'll come to it. We have expanded our distribution footprint for gold loans, which is a very secure way of catering to the priority sector segment of small and marginal farmers. Retail, let's split into two. The secured and the unsecured. Secured continues to be demand on the wheel side. There is a huge waiting period, so demand is outstripping supply. There is intense competition from a loan perspective, but we have done reasonably well. Though, of course, we're very clear that here too, we will not go below a certain risk-based pricing. But I think over the last couple of quarters, I think we've seen that reflect in a solid demand, both from a two-wheeler and also from an auto perspective. Unsecured loans, I think the system itself, we're seeing a lot of new players and a lot of energy in the unsecured sector. I think this is again, in retail, we are very clear. It's a three-pronged strategy that we have always adopted and we will continue to adopt. One is digital, and you will sort of hear from Arvind the kind of digital products that we have unleashed, some of which all of you know, the 10-second loans, which we have been doing right from 2015, or what is the game changer is the new to bank 10-second loans, which he will talk about in greater detail, without compromising on our risk and policies. The second and third pillars is on the risk and margins. We're very clear that if there is intense competition, we are happy to give up volumes. So this is a philosophy that we'll continue to patronize. We are not apologetic about it, and this is so whatever we are growing, we are happy with this kind of volumes. We are in a higher ticket size, and you can see some of I know there are concerns on the unsecured side. There is an industry report which has just come by, but it's largely in the lower ticket segment and probably the new to banking system segment. which is catered largely by the fintechs and the NBFCs. But this is a space that we will continuously watch and monitor. We are extremely conservative on this particular aspect. On the investments, I think we have unbridled appetite to invest in technology. That's very clear. The core, the most important is trying and ensure that our core platform is extremely strong and resilient so that we can minimize the outages, we can ensure the resiliency and the scalability is almost to a near infinite level. We have some way to go. We are not there as yet because we're still continuing to follow the core. We're creating a factory for the middleware called the API factory, and that should be a game changer for a lot of things that we will talk about when we come to technology. On the engagement on the front line, I think we created digital factories in Mumbai, Bangalore, and Pune. I think we have come out with a lot of products. We have not sort of tom-tommed about it. A fair amount of which will excite the user experience. We're just wanting to get scale there, and once you demonstrate that this is good, customers are loving it, then we can sort of talk about it even at the above the line media as well. A fair amount of it, I think Ramesh and team will talk about it when their turn comes about. Second, as we discussed in the last year, strategically we will be expanding our distribution footprint. We had laid out around 1,500 branches every year for the next 4 or 5 years, and that continues to be an important part. Not for anything, it's not going to help us now, but it will surely help us 8 to 10 years from now, because whatever investments we're doing is going to give us the results 8 to 10 years from now, because that's the opportunity to grow in financial services in India, and we don't want the future to be constrained. Whatever we're going to be growing now is for the past investments. Srini and team have mentioned it to all of you all that we still have a large number of branches which are still young in vintage. 60% is less than 10 years, and that's when you start to see the geometric progression of the primary banking moving to us. So investments in distribution is going to be a cornerstone of our strategy. Talked about productivity and efficiency. As I said, whilst we are investing, we're preponing expenses. You will see a little bit of a spike in the cost to earnings from an Indian GAAP perspective. But if you were to, with the merger, I can tell you with the digitization, with a lot of things that are happening at the back end, which is not visible to you, which we will talk about it, I think the cost to earnings will have a downward glide path over the next 4 or 5 years, and then 8 to 10 years. I don't know where we are at about 41%, but I'm telling you, this is one number that I'm very confident and we will work towards, is that in 8 to 10 years' time, we should be less than 30%. And this is not something that is a wish, but it'll happen thanks to the kind of changes that we're going to be doing in the way we are going to be engaging with our customers, the way we are digitizing our processes, not just at the back end, but also at the front end as well. I think since I'm told that we have just about another 45 minutes for this, I will pause out here. We believe that we are all excited. We are all excited in terms of what the bank post-merger will look like. The power of the home loan product itself, it's going to change the way we engage with customers, because it's a very lot of emotional quotient, and it will sort of help us look at that as a hook product for a lot of our interaction with our customers. The second is the power of the group. Frankly, we have not dimensioned it as much, but the kind of now we're all meeting the groups together, it's been an eye-opener. It's going to be something that I feel will really change the game for us, because we have never done that. For 28 years, we have looked at them as associates, but when we come together, I think this will be a game changer, and we're quite excited about that. And it's not just on the retail side, but what it can offer on the corporate side, the MSME side, and the retail side together is something that we can harness a lot more out of this distribution network and this large customer base that the bank provides. So, and also, today we are about 82 million, but when you look at the unique number of customers across the group, I think it's about 100+ million. So there is a 25 million odd where we probably have not even penetrated much. But we will get to know more about it post some understanding of the customer data and profile. And that is, we're eagerly looking out how we can work together as a team and then sort of unleash the power of the group together. Lastly, and the most important is our priorities. If we have to convert this or make this organization into a 100-year-old organization, there are only two things that's going to be the game changer. People have talked about what is not easily replicable of HDFC Bank is our execution capability. And it's very difficult to articulate what that is all about. And I'll try and explain that. It's all about the culture, and it's all about the service-first culture to the customers. We are not perfect. We are not there as yet, but we are good. What we have built over 28 years, we are very proud of. But if we want to now move to the next level, I think we are all collectively trying to work on that employee culture. We have about, as we speak, about 173,000 people, out of which about 18,000 people are the supervisors, about 7 to 8 layers of supervisory architecture. If the 18,000 people with a span of control of 8 to 10, if they try and ensure that they are able to create a great working environment for the 155,000 people who are the breadwinners of the organization, frankly, it will create a great environment for that people who are facing the customers to bring about a service-first culture. That is what we are focusing on. And the way that we are now trying to look at customers, there is a perception that we are more a sales-oriented organization, and we're not apologetic about it. There is a fair amount of good standards that we have laid even in service. Otherwise, we would not have grown thus far over 28 years. But if we now have to move to a new level, we have to internally raise our benchmarks, and that's exactly what we are trying to do. So it's not just me, but it's the entire leadership team who's focusing on the response and the reaction time to a customer, either more proactively or even if it's a reaction, how speed of response can be much better. It's very difficult to sort of put this on a domain and articulate it, but you will see the changes happening because we're going to be at it. We're going to be at it, and that's it may not be tangible for you now, but it will start to see the medium and long-term effects when we start to really execute that time and again with every interaction with the customer. So that's my second most priority. The third priority, as you know, is on technology. We are not there. We are not there as yet. But the amount of hard work the team has put in over the last 3 years has been really commendable. I think they've all spent sleepless nights trying to, manage scale, trying to manage the different components which have a mind of their own. That's sadly the way the architecture was built. But now when you're trying to move away from that kind of an architecture to a new services architecture, it has its own problems, of course. But you have to continue the business as usual and also try and see how you can minimize all the various outages that may happen. It's an ongoing challenge, but they've done a great job. Still a long way to go. But I can assure you, the way we are planning and we're visioning between running the bank and transforming the bank, we will be a tech company which is into banking. So without much ado, let me pause out here and let me take all of us collectively, happy to take a lot of questions.
Thanks. The first question that is on my mind is, as we start the new chapter, how would the organizational structure could potentially look like? The reason why I ask is because as we try to achieve the cross-sell or maximize the cross-sell opportunities, not only from the mortgage customers, but even from, let's say, the group customers, how are you thinking about it? And over what milestones are you setting for yourself and the management team to monitor this? That's my question number one.
So a very important question, because when you look at the way the integration committee have worked, one of the tenets or the principles at which we have laid out is to ensure that we do not destroy the fabric of HDFC Limited's way of working. And there is a reason for that. I think an institution which has been here for about 45 years, which evokes so much of emotions, because now today when you cut across the country, when people think of home or home loans, they think of HDFC, despite the mushrooming of a lot of other home loan finance companies. I'm not belittling that, but the brand which they've created has been amazing. And then when you just peel the onions and try and go deeper into as to why is that, it's the way they engage with customers. The kind of comfort that I'm sure there may be about 200 people in this room, all of us at some time would have said, oh, it's an HDFC approved building. I think I'm okay with that. I would love to. That kind of, whether they actually do it or not, but that is the kind of engagement and the comfort that citizens in the country have got. And the reason for that is right from the time of application, right from the time they ask the home loan officers as to whether this property is good, whether not just the officers, but also to the legal teams, the technical teams, the credit teams, everyone is engaged. And that is probably one of the USPs, because it's a very nice emotional engagement that happens. And that's what we want to harness. The good part is that the timing is so good that we have in the recent past coming out with a lot of digital journeys of all our products. I mean, we now have the complete suite of products, and then the group coming together, we have digital journeys across all products across the group. The key is, how do we orchestrate this and unleash the power of bundling? So this particular moment that we're going to witness is going to be so important, because it's going to be changing the paradigm of how the bank, which has been working on a product basis over the last, whether it's for retail, whether it's for SME, largely corporate has been relationship-based largely, will now change from a product-focused basis to a customer-centric basis, and the person who's interacting will now do all products with a click of a button. It requires investment in the journeys, in digital journeys. A lot of time is gone. We still have some more, which is work in progress. And two, it needs understanding consumer behavior, which is what our credit engines have sort of really, with a 28-year-old history, we have that kind of a knowledge which is there. And three, the investment in a lot of advanced technologies, especially the AI technology, and probably when Ramesh comes in and Anjani comes in, they will talk about the neural, investing in neural networks, and I'll explain that as well. So today, and as I probably may have explained in the past, but we are converting a frontline home loan officer, since you mentioned about home loans, to be more a relationship-based officer for the customer for the entire suite of products. He or she does not have to do too much, because the kind of engagement that we have when we are taking a home loan application is so massive that we have all the information that is required, not just for the home loan product, but all other products as well, whether it's investment, whether it's for insurance, whether it's for other asset products, whether it's for liability products, and the documentation. So the KYC is all done in one go. How do you orchestrate that the moment I sanction, all the journeys of all the other products comes in, so that the engagement, and now we have established a great warmth between the two, and I will say, sir, why don't you take you need to buy new furniture, a new kitchenette, a new television. Why don't you get a consumer durable finance, and this is the offer. One click, done. So what about the structure needs insurance? Why not a general insurance? One click, general insurance done. What about you need to protect your family over the long tenor of the loan? So one click, insurance, life insurance. So if I'm sure the head of risk is out here, he will be more than happy to give a credit card to a home loan customer who's taking a 50 lakhs or a 2 crores or 5 crores, for sure. So why not one click, the credit card journey? And the most important, the savings in the family accounts. One click. I don't need any incremental documentation, incremental information at all from a KYC perspective. Maybe some additional from a PATCA, etc., etc. Otherwise, just imagine the power that is there on fingertips for that particular home loan officer through digital journeys. That'll happen. It's work in progress. Hopefully, in a month or two from the date of the merger, we will have these in place. This will change the paradigm. Now, why am I excited? It's not just about home loans. This thought can be replicated, whether even to an MSME customer. Look at the MSME customer, whether it's a business banking or EEG, which is ramping up. We're the largest MSME bank in the country today. When I go, we have similar kind of an extensive information which is captured for the company, for the MSME, and for also the promoters. Just imagine the same principle, the same orchestration of journeys for the MSME. So the MSME guy will do one-click experience for anything that the promoter wants or the family wants. What are we trying to do? We're just eliminate, look at the productivity. Hitherto, if we did not have these orchestration, the person would have called a branch and give a lead to him. Can this customer so-and-so is wanting savings account and family accounts, can you just go and fulfill that? Then I'll call the HDFC General Insurance. Can you go and complete the structural insurance? Then we call the life. Please go and complete the life insurance details. We go to the card sales team. Please give them the card. We go to the consumer durable finance team. Please go and complete the consumer durable formalities. Look at the 5 or 6 touch points that have happened. We're just completely eliminating that. Like this, now from a sales and a product push, we're going to be, it's easy to say, but it requires a lot of orchestration, and it requires the ability to manage on scale. So we are excited because we're going to be moving from a product sales perspective to more relationship and a customer-centric sales perspective, and that is what is giving us, and that is giving me the confidence that why 10 years from now, or 8 to 10 years from now, it will be a less than 30% cost to manage. This is
take another one, just the last point, which you said cost to income of 30%. It's quite thought-evoking, but will it be more cost-driven or income-driven? The reason why I ask this question is because on the income side, you again have a lot of players competing in the market. There's always a pricing pressure.
Yeah, sure. It is purely the jaws opening. Number one, to reiterate, we are not going to be, nickel and diming on our investments. We are going to be investing heavily into technology, heavily into a distribution network. The productivity of people will be much, much better. There is fluff today. Today, are we efficient? Not as yet. It may be from a banking perspective, it is still one of the best, but I believe we can still, young Srini can juice out even more. And he will do that. With the orchestration of journeys, trust me, it'll be even better. So it's not going to say that our cost is going to go down. Cost will increase, but revenue will be much better. As I said, we are still not reached a saturation point wherein our margins is going to be eaten up. I mean, this is something only we should worry about it maybe 50 years from now when there is some amount of saturation in the penetration levels of financial services in the economy, which is still underpenetrated. The fact that you're going into semi-urban and rural parts of the country, it is a virgin market. It's something that the growth is there for grabs, but do you want to take all the growth? No. We want to take the top 20, 25%, which gives our credit team a peaceful sleep. So I don't see, when we say the cost to earnings is coming down, we will see the jaws opening up as the operating leverage starts to kick in, but not your expenses will continue to grow.
Hello, sir. This is Shantanu from BNP Paribas. Thank you for the opportunity. Just one
Shantanu,
thing I
where
wanted
are you?
to... Yes,
Yeah.
So just one thing I wanted to ask you. If I look at the last financial year, and in fact a little bit beyond that, the deposit mobilization performance of your bank has been nothing less than astounding, at least to me. Now, the part about that which has often been discussed in media is the sheer quantum of fixed deposits that you have mobilized. I would like to focus my question on the other part of the equation, which is CASA.
Yeah.
Now, the system level CASA number in itself has been slightly anemic, which is why the market share numbers that you have put up kind of seem to have gone under the radar a little bit. But we have looked at it and we are quite impressed. My question to you is a simple one. What has made you gain the kind of market share that you have, which is, almost double your normal run rate in the last 12 to 15 months in current account, savings account? You can break it up between, say, how much your branches has contributed to your mind, how much new digital forays have helped, and how much of it is cross-sell into the parent entity and things like that. That would be very, very useful.
Sure, thank you. Yes, it's been pretty good. I think this is full credit to the team who really worked hard across verticals to do that. I think if you go back about a year ago, we did mention that we will start to work harder 1 year, even as the announcement of the merger started. We were warming up the engine. See, frankly, it's not about rates. It's not about digital journeys. It's not about any other external influence that's giving us a kind of momentum. As I mentioned, even distribution is not, all the investments that we are doing in distribution today will kick in, but the real meat of that will happen 4 or 5 years from now after you have after it has reached a certain amount of vintage and maturity. But what is crux is the quality and the intensity of engagement, customer engagement. That is the only secret sauce to it. There's no shortcut, and that is what I've seen this, going up day by day. But if you ask me, internally, we are not happy. We still believe that we can do better. But credit to the kind of customer-facing verticals, whether it's the branch distribution, whether it's a virtual distribution, whether it's all the other verticals, whether garment businesses, whether it's the asset businesses, the payment businesses, all of them have stepped up their engagement with the customers, which is the reason why we are able to get this kind of a momentum. We still believe, and we wanted to test ourselves, whether the level of it, I mean, I'm talking about retail, because wholesale, as you know, is it's not an easy business to be in to get, and whatever flows are coming in is very momentary, transitory, volatile, and that's the nature of the business. So we are looking at the core granular retail, which is what can actually fund our balance sheet, and all of us in the leadership team is focusing on the retail part of it. Whilst optically we may have grown about 150,000 crores in the last quarter, but it's just a 90,000 crores, which is what we were talking about. I need to do before the merger a 90 to 100,000 crores. We got about 92,000 crores, I believe, in the retail side, which is a very commendable effort. It's not something we can brush it off as passing, but a lot of hard work. And the only thing that has helped us is engagement. I believe, and you talked about CASA and you talked about time deposit. Frankly, if you ask me, we are very underpenetrated on time deposits. We continue to be. We are still about 14%. You know, out of 100 customers, only 14 of them have kept deposits with us. I mean, there's something wrong, which means that the runway is large. We have not asked, now we're starting to ask. And that's why you're seeing this kind of a growth. So we need to be at it. I know there is some play on the interest rates, but largely I think it's all about engagement, which is what will take us to the next level. We are not apologetic even if it's growing at 30% and the CASA is growing less. You alluded to the fact that the CASA has been anemic in the system, and that's pretty much logical, because you had, during the COVID periods, take this room as a microcosm of India, we wouldn't have spent. We didn't have avenues to spend. We were just doing for our basic groceries and etc. We didn't go out. We didn't travel. So you did have a buildup of this slightly extraordinary balances in savings. And I'm sure if you go back to the last 2 years during COVID period, you did see a very healthy growth in the system on the savings accounts for sure. Last year was a year where people started to travel, people started to spend. There was a kind, at least in the middle and upper middle income, there was a term used called a revenge spend, and that was very much expected, and that is very much expected to bring down some of the balances, so which happened, which is why it is anemic. But now, going forward, it should not be. It should be normalized. The spend pattern should be normalized. If that is the case, and you've seen, despite that, despite the growth in time deposits, we don't have a bad CASA ratio. We continue to be in the 40s, and this has been our average CASA ratio for about 20 years now. So we're all right. It's a combination of, now, you know, it's not going to go down, and I'll tell you the reason why. As we start to step up our engagement with customers, as we have our home loan product and the group products and energy coming in, as we orchestrate our digital journeys to make convenient for our people to engage with customers, these are all enablers of liability. You know what? I'm not too sure whether they have put in the domain, but at some point in time, we have done an internal exercise where a person in this room, when you take an investment product, when you take an insurance product, when you take a card product, when you do a bill pay, when you take a loan product, all these are actually enablers of liabilities. Your balances of good customers starts to go up. So even an FD, because if you don't sell an FD, another bank will sell and that'll deplete your balance. Whereas you may as well keep the balances within the ecosystem. So we are going to be focusing on more and more relationship management, customer engagement, which is what we will transform this institution into a more relationship and engagement-based focus. And I'm not expecting any dramatic change in our CASA ratios. We still are confident that despite selling more FDs to customers, we will still maintain a healthy CASA ratio in the 40s. I think we've had a range on an average basis of 30 to 42 for a 40 or 20 years, and we will continue to maintain that. I know it's slightly higher now, but I think these are levels which will ensure that our margins will be in a stable band of whatever. I think with merger, it will be about 3.8, 3.7, 3.7, 3.8. That's the change because of business mix. Otherwise, so it'll be in that band with the cost of funds reasonably, I would say, in a tight range, despite more and more FDs coming out of last year. Yep.
So over here. Yeah, hi.
Yep.
Can I go ahead?
Go ahead. Go ahead.
Yeah, Anand from MK.
Oh.
Sir, taking ahead the cross-selling question basically is that, no, it's easier said than done basically that we want to cross-sell. If you look at the slide in the background, we have right now about 3 products per customer that we've been able to sell all these years.
Yeah.
Now that we're talking about the power of the group, where basically we will be cross-selling a lot of products to the group customers. Already these customers are bankable customers. There are other banks who already penetrated into these customers. So one is that you will have to dislodge the other banks. So what is going to be the strategy for that? And basically if there are the virgin customers that you have, basically how many products that you intend to sell to those customers? I'm sure you would have the analysis like how many products are already sold to these customers and how do you want to take that forward? No. Third is that the existing customers that you have for the bank, where right now the product penetration is somewhere about more than 3x is what you're talking about, 3 products. So what kind of products, like 5 to 6 products that you're targeting, and within which it includes the liability products, asset side products. So which are those products that you would want to sell? So more detailed discussion on cross-selling is what I want to understand.
So, see, number one is it's not our culture to dislodge anything for the sake of pushing our product. I mean, that is the last thing that we would do. You look at our, I think I see some data which is there behind, which shows very clearly, despite being the market leader in credit cards, despite being the market leader in asset X mortgages, and of course, you know about mortgages as well, and insurance, and you take the mutual funds up. We have done reasonably well overall from a relationship and the engagement perspective. Still, the penetration is very low, which means that the opportunity is large. See, one of the things that we have realized is, I mean, this is not new. I would say around 2010 or 2009, 2010, we said that we will not force a product push to a customer because we want to do it. We came out, we invested in advanced technology, in analytics, in now more AI-based analytics as well, which will ensure that whatever we sell is need-based. And that is something that we will not compromise. So if I know that he is a customer who does not have a need, we will not push it forward. We will sell only, we believe analytics is showing that there is a need. So the point is that ultimately, I'm not here to dislodge anybody. I'm just here that we have a superstore of products, a bouquet of all products under one roof, and we have technology to help us identify those kind of customers who have a need, and we will push it. The intuitive thing is, how can we step up more and more? And that is right. More and more we do, the more stickiness that one will depict. The fact of the matter is that when you look at the longevity of our relationships that we have, especially when you have a liability relationship which has an overlay of a lot more products, the life is much, as they call it, near perpetual or a long time. So all the products that we're excited about, whether it's a mortgage product, the group products that we're talking about, is something that is to enable the primary banking. The more I have the primary banking, the more annuity for the organization, and that's where the value is more strong, more, you have a more longer duration of annuity that starts to kick in. So it's not about that I want to have a 5 to 6 products. Identify those customers where I can very effortlessly see the need for it, and then we will sell. So with technology, whether it is the ability analytics, whether it's our digital orchestration that I've spoke about, I think the penetration can be better going forward. The narrative or when I talk to you as a customer, I probably will have a more intelligent conversation with you now, and the ability to close out products will be much better. And that's the reason why we are saying that we probably will have a lot more better penetration. If you're saying 3 is where the average is, yes, even if you go to a 3.5 or a 4, the needle just swings dramatically. But the propensity of doing that is much more now with home loans coming and the power of manufacturing some of the investment insurance products, making it bespoke. Today, we didn't have that kind of engagement with the group companies. Now you will have the fact that we never orchestrated digital journeys. We were all working in different product streams. I had a cards team, I had an assets team, I had a BBG team, EEG team, a merchant team, a branch team, virtual team, government team. Now everyone coming together through the digital orchestration. I'm saying that we will start to see this coming about in a big way over the next couple of years. So that's the cornerstone. Ultimately, that is what is going to be the game changer. How we orchestrate that, how we engage with customers is going to be which is what we are focusing on. That's the main thing for us. So I don't have a number, but you should see the trends moving.
Hi, Shashi.
Hi, Vishay.
Hi. Thanks for hosting this session, and congratulations for all the hard work which is going on. Question for next 3 to 5 years, especially given the landscape actually has changed. So what has happened in last 6-7 years is bulk of the banking system was suffering through NPA cycle,
Right.
capital, etc. Now clearly they have appetite to grow, as can be seen in the latest numbers. Almost all SOE banks are also growing 15% or 20%. Which basically brings pressure both on the liability side and also on the margins for us, and our own relative size for the bank. Like now you would be like 13% of the system roughly. So your ability to grow a differential to the industry, which has been let's say 1.7 or 1.8x of industry growth rate over time, like that looks like should be under pressure, or the differential has to come down significantly, and that's the major pushback actually. So anything you can share on that?
See, you're right. I mean, one would have expected that. But, I repeat this kind of a thing. I mean, when I had this question in a budget session with all of us around, I posed this question to Mr. Puri. He gave me a nice lesson, not once, twice. Once in the boardroom during a budget session, and once again somewhere in the coast. I think it's a Mangalore coast, where he said, when you're large, okay, you have the capability of throwing a larger net and catching a large fish because the ocean is large. India is still large. India is emerging. India is underpenetrated in financial services. As compared to all the others, including some of the larger, it's only we are in the top 2, top 3. Everyone else is below, so they are small, so they will catch lesser. So you don't give me, and it is a lesson to all of us, don't give me this kind of a bullshit saying that you cannot grow because you're large. I mean, that mindset, we learned it in a very beautiful and very simplistic way, I must confess, and that has been etched in my thought process as well. So India is still large. We are underpenetrated. We believe as a dominant player, you will be able to cast a larger, the bigger people, the larger banks will be able to grow much faster as long as they don't, indiscriminately grow. Two is in terms of margin. The second aspect, if you look at it, our geography expansion has been not just concentrated in the urban and metropolitan locations. It's been to a large portion of the semi-urban and rural. We still have about over 50% of our branches there. Frankly, it's a virgin market. It's a lot of players are not present there at all. At the same time, whilst the opportunity is huge, do we want to capture all? No ways. The credit guy will get a heart attack. We want only the top 20, 25, or 30% of the market there, because that may probably mirror the middle and the upper middle income segmentation, or the kind of segmentation that they are comfortable with. So it's a virgin territory. Look at the credit deposit ratio. So the opportunity, both from a funding and from an asset perspective, is very high there. Three, you talked about competition. Competition has been intense even during the last 5 to 6 years. And you may find it very counterintuitive, especially when they were going through a lot of bad patch. You may think that, oh, why am I saying that? One would have expected easy grabs for us. Not really. When you're under this stringent, during that period, where a lot of banks were called, what is that action? RBI action? What is it called? Prompt corrective, PCA. The PCA banks had a larger scrutiny, not just by their boards, but also by the regulator, who were monitoring daily on the basis. They had stringent measures to ensure that they had to meet, and because the regulator was also involved, it was extremely, the entire machinery was on their toes. Frankly, during that period, it is one of the most difficult to take away the best. You see, we didn't want all the customers. We wanted the good customers. They used to shield their customers even more. So to have grown in that particular phase, to be growing deposits in one of the toughest liquidity environments that we've seen over the last 1 year, means that there is a execution machinery which is reasonably well oiled. To probably the best of the bank comes when we have a lot of these pressures on. And that's a reality. We have demonstrated this. So we are not so overawed by the kind of competition or the competitive environment, or the fact that we are large, or the fact that things are changing. I think as long as the economy is robust and resilient, as long as we don't have any dramatic events which will, whether it's a COVID event or whether it's a global financial crisis or any other demon event, it doesn't sort of upset the macro suddenly. As long as we have things, the ups and downs in a normal business as usual cycle, I think we're large enough to withstand these kind of pressures and manage what we have grown over the last many years. We can continue to grow. I'm very clear about it. No excuses. We cannot give excuses for that. And this is not me saying, this is the entire leadership saying on behalf of the bank.
Sorry. The last question from my end is physical versus digital investment.
Yeah.
So what is the incremental cost of adding this physical network for us, and how that compares to our digital investment or digital cost, let's say for last year, and how you see that over the next couple of years?
See, this is an important question. All our incremental distribution investments that we're going to do will have a larger component of digital infrastructure, where onboarding and transactions will largely be digital. In fact, you will see maybe in about 4 years' time, I've given a shorter time internally, 4 years' time, you will not have tellers at all. because ultimately the onboarding and the transactions will all be digital. Then why do I need this infrastructure? See, when you look at a pure digital infrastructure, it is cold, impersonal, and it is, it will allow a lot of convenience for people to keep shopping around. It's pretty much evident when all of us in this room try and buy something on Amazon, we go and check on Flipkart or Myntra, or the ladies, when they try and do it on Amazon, they check on Nyka's and all these things, etc. So shopping around will be there. But the moment you put a human interface, a warm body, an engagement, that sort of changes that. That brings in a kind of respect to the customer, a kind of an empathy towards that, the ability to do things very seamlessly. The Gen Z or the youngsters may not need it, but as their life cycle moves up the chain, they will not have time. None of us in this room have time. We need someone to take care. We need someone to help us out on that. So our branches are going to be the engagement centers. We'll have relationship managers more and more to engage with the catchment around. And this is not just distribution in terms of branches. As you know, you will see when Smita is doing that, she will also talk about alternate channels as well, how we are trying to mimic a branch into an alternate channel as well, with the same kind of, hold on the catchment. That's another exciting thing which will really help us to, step up the distribution much faster. So coming to the cost of investments, the cost is going to be the incremental cost of investments that we are putting up is going to be much, much smaller than what we had done on a like-to-like basis in the past. You don't need, like for example, when we went to, whether it is in Pali in Rajasthan or whether you go to in Thoothukudi in South, the branches are now just about 400, 500 square foot, with multiple kiosks. You will have the cash recyclers, you will have today it is cash ATMs and cash deposit. Now you will, hopefully, they will combine it into one called the cash recyclers. Then you will have the kiosks for all RTGS to other payments. And then you will have just the relationship managers inside the bank. That's it. So the size would have come down dramatically. It's more the incremental investments on these kind of infrastructures. So incrementally, the investments will come down for sure. So my point is, while we'll ramp up in volume, the numbers will be larger because we want to have a far more denser coverage of the catchment. Today it's average 7 to 8 kilometers is what one branch covers, or maybe slightly more. We want to get it down over a 5-year period to about 4 to 5 or so. Even that is not too good. The opportunity to continue to grow is there and make it even denser.
One thing, Vishal, is that you touched upon the physical and digital. They are not exclusive. That's I want to leave it. All the rest you heard from Shashi. They are not exclusive. The digital is complementary to the physical process of having that relationship management. And the profit pool is there. In a straight through digital, it is about the efficiency, and the profit pool comes through relationship management.
Yeah, hi. Morning. So my first question is on mortgages, because the entire merger, if you may say, is kind of predicated on that. We've seen a very good run for mortgages for the sector during COVID and even following it. And obviously, the long-term potential for mortgages also looks really strong, given the under-penetration. But given that a lot of revenge spending or a lot of pent-up demand has already been met, do you see the next 1 to 3 years as being slow off a low base, because already there were some complaints by some players on mortgages slowing down in Jan, Feb, and then they picked up in March. So do you see any short-term or medium-term slowdown in mortgages, and how would you navigate that? That's my first question.
See, short-term movements will be there in every product. It'll be there in corporate banking, it'll be there in retail assets, it'll be there in unsecured, it'll be there in cards. We cannot sort of have a strategic view basis short-term movement. But the most pertinent part of what you said is that it's an under-penetrated market. So as long as players are able to tap the right kind of a segment without compromising on margins or risk, I think we should be comfortable. And that's where the distribution play will help. That's where the product, what shall I say, superiority will help. The brand recall will help. So if you ask me, we have not even leveraged, we have not even sold home loans in 28 years. We have only distributed the product. So the fact that the entire distribution will start to talk about it, you know, that itself is going to be a game changer for us. And we are not talking that and because it's underpenetrated, we are going to be picking and choosing. So I have a slightly contrary view. Actually, you will see it's okay, even if short-term movements happen, even if there is a bit of a dip, it's okay. But the medium to long term, I think this franchise should be able to do much, much better than what we have ever done on this product over the last 28 years.
And my second question is that you're the second CEO who sounded some caution on personal loans. I know it's not on your ticket segment. It's probably on lower ticket.
No, I am not saying it. I just happened to read an industry report which talked about the same. It came about a couple of days ago, and it said that less than a certain ticket size, there is a bit of an issue. That's all.
There's something that can be fixed, right? It doesn't spill over anywhere.
No,
else.
my point is, you know, which is the point? I mean, we have done this for 20 plus years or 25 plus years. We know what works, what does not work, which segment works, which segment does not work, which geography works, what kind of customer profile works. And that is the beauty. That is our USP. So therefore, we are growing, but we are not growing indiscriminately. And that is the reason why we have seen, you know, a very reasonably stable NPA for over 28 years on this unsecured product. So we have not sort of gone, in fact, I believe it is better than even the pre-COVID levels as we speak. But having said that, the two things that we are not apologetic. If for whatever reason certain thing changes, we will be because of our risk management and monitoring and measurement, we will be the first to be cautious about it. So we need good margins to price for risk. If either this does not happen, then we are okay to give up volumes. Or if we see some amount of contagion effects in terms of higher leverage for our customer segment, even that also we will curtail. And that's probably one of the reasons why we have maintained a reasonably healthy portfolio.
Yeah. Hi. So, Shashi, three quick questions. One is, you ended FY23 with a 2.1% ROA. So the single biggest question that every investor is asking all of us is whether you can maintain the same ROA post-merger. Now, will it have an immediate impact because of the merger? And then you can retrace it back, say in a couple of years' time, or you're confident, right, day one of merger, you can sustain the 2% ROA going forward. So that's the question I think most of the analysts would be having. And can you deliver 18-20% growth also while maintaining the same 2% ROA?
All things remaining same, the opportunity to grow is huge. Frankly, we are the only sort of critical factor that we need to work harder is to ensure that our granular funding continues to kind of momentum that we saw in FY23 in a much more severe liquidity conditions to continue to do so in FY24-25, which is the most important year for us. Because once during the merger year, once we get that asset and liability, what shall I say, the merger impact of that in, I think subsequent years should not be a bit of a problem. So this is going to be very critical for us. We believe that whatever we have seen in the last 3 or 4 quarters in terms of the kind of engine, how it has generated granular liabilities, I don't see any reason to worry about why we cannot replicate it in FY24-25 as well, which means that the growth rates that we have seen in the past, which are without giving any future guidance, should be protected. 2, on ROA and ROE, yes, ROEs will go down. Let me address that first, because you will have a larger capital base, and that is something that is pure math. It'll take it's like capital raise. And so the same event will happen, but we are very confident that in about 3 to 4 years' time, we should, or even earlier, we can catch up to the pre-merger ROEs. On ROAs, I think a larger balance sheet, a lower margin, but a lower cost and a lower credit cost should enable us to maintain the similar levels of ROA even going forward, even from day zero, is what my belief is. But what we are quite excited about is that when we unleash the power of bundling, in fact, it should change the ROA slightly better. And that should start to be visible, not on year 1, but maybe year 2, year 3.
So day 0, 2% ROA. Okay, fine. So that's
I mean, why 2? We have given a band 1.9 to 2.1.
Okay,
that will be.
We'll take that. The second question is on the liability front, right? So let's do the math here. So you have a 21 lakh crore of loan book. Let's assume hypothetically you want to grow 18 to 20%. That means you need about 4 trillion rupees of deposits, right? So it's pretty straightforward calculation. Now the challenge here is you're getting 5.5 to 6 trillion rupees of liabilities from HDFC Limited. Now, what is the path in trying to replace that with deposits? Of course, they do have 1.5 trillion rupees of deposits, but the challenge is the balance 4 or 5 odd trillion rupees. How do you manage to replace that with deposits in due course of time, or will it run like a silo, the same swap structures, the way the ALM of HDFC Limited is, that will continue in HDFC Bank for the foreseeable future?
Yeah. See, you know, we did not have too many long-term funding, which is why we didn't have to resort to too many of these, what shall I say, derivative swaps. But having said that, if I'm now going to be inheriting a kind of a longer-term book, no reason why we will not continue. We'll continue. In fact, it's a great, you know, it may not be, I'm sure you can ask Partha and Arup when he comes in. It may not have, the benefits would have not come in if you've done deals last year because the curves were not so, what shall I say, conducive for benefits. But I think as rate changes, I think you will get back that mojo back on that. So we will, and there's nothing wrong with their liability that they have raised. It's a pretty decent cost. I don't want to jettison that. As and when it starts to mature, I think our engine will be able to, either we can roll over that, or if the liquidity comes back and if you have ample liquidity from a deposit mobilization perspective, it will happen. So you will see the kind of a differential advantage in cost of funds, deposits and borrowings put together, you know, play out not just in year 1, but over a 3 to 5 year period.
Okay, and final question is, does HDFC Life now, you becoming a parent rather of HDFC Life, does that change the dynamics for you? Would you start selling more HDFC Life policies through
Very
your branches?
mischievous question you're asking. I know that. You know, we will yes, two things. Number one, we believe in open architecture. It is not for anything. It will keep us and the group companies on their toes for good product and service offerings. But having said that, we are going to be more, the parent-child relationship is also going to be an extremely important factor that we cannot ignore, because in your own analysis, that's going to add to the sum of the parts. So you will see the power of the group, including HDFC Life, being given a slightly important status. You will see the proportion of business going up, but I will not go 100%. It will go up. It will go up from the current levels. But having said that, we like the open architecture. That is also equally important. So we'll have the right balance between an open architecture and the father-child relationship.
Hi, Shashi. This is Nitin Agarwal from Motilal. Two questions now taking forward from this life insurance. Which are the other subsidiaries you think wherein bank can make a big difference? Like on life, we are pretty clear that.
No, even general, even AMC. See, ultimately today, I'll be honest, we were distributing all of them, but we were distributing as an associate. We were not sort of harnessing the power of digital in our foray, the power of engagement. Simply put, when a relationship manager, maybe in a Neerav's team, 𝐾𝐽𝐻's team, or an SME team or retail team, we wouldn't probably have taken or talked about general insurance. We may not have talked about the superannuation, the gratuity funds of the life, and there are a lot of mutual funds, which I'm sure all the companies and treasuries do, whether it's an MSME or a large corporate. Did we actively say that you can invest there? No, we did not. We did not take it. I mean, that's the reality. Now, suddenly, that'll come into the fore, that the power of the group can come in. Obviously, it's not going to happen overnight. It has to be how the chemistries of all the group companies coming together, trying and engaging with the respective teams. See, everything is about engagement, whether it's internal or whether it's external. So it also depends on how well the group companies and the bank engage to train on the products, to orchestrate in terms of the interest, to go jointly in our calls to the customers. All that is something that will start to happen over the next year or so. And when that happens, then trust me, I think the benefits, the access that one has, they will have to the rich repertoire of customers that the bank has, is going to be unimaginable. There will be a lift, for sure.
And in this context, how do we look at our own subsidiary HDB Financial? What is the medium-term growth and outlook, profitability outlook on this company?
It's a company that we all like, because it's a segment that we are not participating as a bank. It's completely a notch 2 level below the bank. So it's independent, run very well. They weathered the COVID period extremely well. Very proud of what they have done and what they're doing. We need to wait and watch. I mean, even the regulators were extremely busy on the merger and the forbearances, etc. Now that should be behind them, they did tell us that we will talk about HDB, because ultimately, though we have explained that these are two different segments, whether they will allow us to keep it as is where is, with a little bit of paring down, or whether they want to do something else, is something that we have not engaged with the regulator. We will have to engage.
And my other question is on the business mix. We have talked about retail, we have talked about MSME. Now with the merger happening and the mix of retail increasing, and traditionally we have always talked of a 50-50 mix between retail and corporate. Now retail mix is likely to go up a lot more. So will you look to step up the efforts on corporate banking, and what will be the revised business mix that you'll want to have?
See, corporate banking, we have never, in fact, it's a misnomer saying that corporate banking has grown only now. It's been growing for the last 20, 25 years, steadily between 15 and 20%. It's just that retail has sort of been far more, what shall I say, optically more visible. And that's the reason why they believe that we are a retail bank. In reality, we are a very balanced. We are there in corporate, we are there in MSME, we're there in retail, and if you go back in history, I think all the segments have grown reasonably healthily with the same principles: your segmentation, the risk, and the margin. Anything which gets upset, we are happy to give up. Like in the last year, if there was, and Kaizat will sort of talk about it in detail in the next session, you will hear from him that if there are certain things which are not making economic sense, they are happy to give up. They've given up more than.
So I'll just step in over here to.
How many crores you have given up?
So if you go back and check Srini's commentary at the end of every quarter over the last financial year, and if you add it up and if my arithmetic is right, for our customers, for our quality of customers, so keeping that standard, we gave up close to 100,000 crores of opportunity of corporate banking assets in the last financial year, because we wanted to maintain a pricing discipline, which we did not find being adhered to in the market. So if I needed to grow corporate bank, even if I did half of that 100,000, I would have beaten the market 10x. If you also see, and I don't want to cannibalize what Neerav will come up and say, but I'll steal one data point out over there. In the last financial year, large corporates in the banking system grew 3%. HDFC Bank grew 12%. If I had taken even a portion of that 100,000 that we let go, which met our credit standards, I leave it to you to judge where we could have grown if we just wanted to chase growth. So it's a good balance, as Shashi was saying, that we manage between asset quality, customer engagement, and pricing discipline to ensure that the corporate bank across ECG, corporate bank, ensures that we get the right ROAs as well as ROEs. And that's the model we've run through the years. Also, to repeat a point which he made, we've always been a bit in the background, but I assure you, we are a very strong contributor to the bank's overall balance sheet, whether on assets or earnings, or for that matter, even on self-funding on liabilities.
Coming to self-funding on liabilities, they mastered the art. You may say on a point-to-point basis, you may see a muted growth. In reality, they've actually done a short-term liquidity measure in the form of interbank participation certificates. Today we have, as of the year end, about 60,000 crores, which they have sold. And it's a wonderful way of, self-funding. So effectively, it's a temporary way of trying to ensure that you're with the customer at the same time, trying to ensure that you churn so that you're not putting a drag on the overall funding needs of the institution. So therefore, don't go by the optical growth rates on corporate banking, because there is a fair amount of liquidity management that's also happening, which you need to look at it. Maybe the averages will show much better growth rates. Have a look at that.
Thank you so much.
Hi, Sameer from JM Financial. Just a quick question on the tier 3 to tier 5 center kind of distribution footprint. How does one look at the break-even of those branches, given that they are smaller in size, maybe lower OPEX? Does it break even earlier, or just because the pie is smaller, the overall number remains same?
Sameer, you're right. The tier 3, tier 4 are the areas just outside of maybe the top 100 towns, the main ones, like, outside of Nagpur, the Yavatmals, and etc., or a Trichy, or a Thoothukudi, or a Tirunelveli, etc. I'm telling you, it's buzzing. The energy is there. So it's small, cost is low, but the break-even of these branches are much faster. Normally, we would do about 18 to 24 months, but we are seeing in the tier 3 to tier 4 that actually the break-even is coming slightly faster.
Great. And would it be okay to disclose what would be the Metro and Suru deposit mix in our pie?
You have that? What is
No,
it?
we haven't published that.
Okay.
We'll look at it.
Fair enough. Thank you.
Sashi, morning, Manish from Access. So far, whatever we've heard is all positive. FY23 has generally been a great year for the banking system. At this stage, what are the 2 or 3 things which worry you the most as far as the bank goes?
See, frankly, we are a large engine, an execution engine. Okay. Now, getting this engine of 7,800 branches, which is growing about 1,500, getting the 1,73,000 people with the same kind of a culture, getting our massive technology, which is one, running the bank and also trying to transform, getting it right. So it's all about the execution, it's nothing else. We have weathered multiple business cycles in the past. We have weathered even event risks in the past. I think the organization, no credit to me, but to all the people, the founding father and to all the people who have built this over 28 years, I think have made a wonderful engine. So it's just that keeping that execution of the engine running that's the main risk.
And in the past, we've had some challenges 1 or 2 times with tech outages, etc.
Yeah.
Now we are going to operate at a significantly bigger scale.
Yeah.
Whatever changes you implemented over the last couple of years, are you comfortable with your ability to execute at that scale?
Yes and no. I think a lot of hard work has gone in moving a fair amount of our in the cloud. So from a scalability, availability, resilience is there, but it's not complete. It's a massive ship. So to move the balance applications onto the cloud will take a little more time. And that is something as per plan. But in this kind of an environment where we are dependent on multiple partners who have built our architectures in the past, now that we are moving away, obviously we have to keep them in good humor. These are some of the challenges. So we are better in terms of outages from where we were, but is it zero? No, it's not zero. We have not licked it as yet. We still have to, get our, but at least I can tell you the disaster recovery has been amazing. The orchestration that now the team does is very good. But do outages happen? It still happens. Is it something that is under our control? Partly, partly not. So these are the execution challenges that we are having. This is probably execution challenges even large entities in the world will have. I mean, whether it's a US bank or a Singapore bank, or you have the largest cloud service provider also, all of them go through outages as well. But I can assure you something, that as we are factoring in and as we are sort of investing in more advanced technologies, there will be an inflection point where we can, and I'm telling you this, there are 2 goals that Mr. Ramesh and company has. And one is he will yank the system and nothing will happen. Instead of someone yanking it, they will yank it, but the bus will move, the engine will move. The second one is we are about 4 nines today in terms of availability. I don't know where he is, but yeah, I'm sure the moment he starts to talk about 6 nines and 7 nines, I think we will be far, far higher than. These are the 2 visions that we have for ourselves in technology. That will be the statement that we would want to watch. We're still not there. We may be 4 nines. To go to a 6 9 will take a lot of effort. But that's the vision for it.
Yeah, hi. This is Prakhar from Elara Capital.
Louder.
Yeah. So just your thoughts on payment ecosystem. So when I look at one of the things wherein bank has been essentially a banking system has been lagging was or a late mover
I can't hear you. Can you?
Now is it better?
Yeah, now it's better.
So I'm talking more from a payment ecosystem. One of the segments wherein banks have been a relatively slow mover or let go of advantage that they could have had was on sort of payments sides of things. And there are a lot of entities that have mushroomed because of that. When I look at few slides that you have presented, the deposit side also, the customer base is maintaining 5.8 sort of on a deposit side. How do you look at this space and how do you look at opportunities from this angle?
When you're talking about payment, it's because of the UPI apps?
Yes.
Okay. Yes, we all blinked. The entire banking system blinked. But having said that, I think the large banks have caught up on building an equivalent great customer interface or even better. We are also one among them. We have come out with something which is a rebirth of Pays app. And we have not sort of marketed it. We have just silently allowed people through word of mouth to start to download and use it. We probably today have about 2 million or 1.2 million customers on that as we speak. We just launched it about a few months ago. I think that's been our thought process that we should, like other banks, large banks, get back that mojo. Yes, but there's nothing lost because ultimately, even for the payment apps, whether it's a top 3, which are ruling the roost on the payment apps, their business model is not there today. I mean, you know this much better. Unless and until they partner with large institutions for harnessing those kind of data that they have. So we are going to be riding on that. We are partnering with one of them already, but it's an experiment phase. We will not scale up till we are comfortable. We will be partnering into the other 2 as well. So we are open. Banking as a service is going to be the new as we develop our APIs and we create a great, robust API factory. You will see a new line of business coming out from our stable, which is the banking as a service, which will not only partner with these UPI app companies and try and ride on their data, of course, with the appropriate consent architecture. But we also on our own, you will be surprised, and over a period of time, you will see the kind of traction that each large bank, when they come out with their own apps, you will see that happening. There is already the largest bank in the country, which is come out with a very good app. You will see the number 2 and number 3 also coming out with their respective apps, trying to get back that mojo. But nothing is lost that way because ultimately we realize that unlike in the other jurisdictions of the world, these apps cannot sort of really harness because the regulations are different in India. And the only way they can really juice out is partnering with entities like us. So we are getting back there and we will ride on even the very apps to our advantage.
Thanks a lot.
Hi, Sashi. Abhishek from HSBC. So my question is on MSME. You said that the bottom end or the lower end of the MSME doesn't necessarily have very good asset quality. Now, if you look at the, let's say, last 3 years, incrementally, a lot of banks have started to grow pretty aggressively in that segment. And you have continued to grow at about 30% in that segment as well, MSME put together. What gives you the confidence about the incremental book that you're acquiring, that's of good quality? And do you need to pare down the growth to adjust for quality, or do you think there's still a long runway even for that, given the competition around?
Good question. I mean, the extent of growth is not something that we want to. And whatever growth is happening is with the right segmentation that we are comfortable with. That's very clear about it at all. And you look at it, even when you, compare with the industry, we are far lower in terms of the delinquencies arising out of that, even as we speak. And the USP of that is not because of, there is an opportunity. There is an opportunity, and we are in the top segments in each and every. It's very well diversified. We are not into the entire range of MSMEs in that geography. We're just in the top quartile, as I would say, the top 20, 30% of that particular sector, even lesser. But the USP is in the risk management and monitoring. That has been the cornerstone for all these years, and that is what is keeping us good stead. We have an independent vertical. There is a constructive tension. Mr. Shukla and the credit team are always having nice constructive tension, boxing matches out here. But that's something that is welcome. That is the reason why we are reasonably happy. And so the kind of growth that you're seeing, it may pare down. It may pare down. We're all right with that. But whatever we put up, I don't think we should be apologetic at all, because it is good quality book and there is an intense monitoring that happens.
Sure, thanks.
Thank you all. Always a pleasure to talk to you. Thank you and all the very best.